Welcome to the latest episode of our podcast series for financial advisors. Today's episode is The Evolution of an Elite Advisor, from breakaway to M&A to increasing annual revenue by $10 million in just 3 years. It's a conversation with Justin Berman, co-chairman at Crescit and founder of Berman Capital Advisors. I'm Mindy Diamond, and this is the Diamond Podcast for Financial Advisors. At Diamond Consultants, our mission is to help advisors live their best business life. We want every elite advisor to find exactly the right place for their business and their clients to thrive, whether it's at a wirehouse, a regional, boutique, or independent firm. As the industry's leading recruiters and consultants, we've transitioned more than $250 billion in assets under management in the past decade, and each year, 25% of transitioning advisors who manage $1 billion or more are our clients. If you'd like to talk, please feel free to give us a call at 908-879-1002. Are you a financial advisor who's curious about whether you're in the best place to serve clients, or if there might be a better way to optimize your business for the future? Should I Stay or Should I Go is a new book that serves as a self-guided journey, walking you through the key steps that Diamond Consultants takes with our advisor clients, whether considering change or not. Visit diamond-consultants.com/thebook to learn more. It was May of 2020 when Justin Berman first shared his breakaway story on this series. In Life After Goldman Sachs, Justin shared his perspective of leaving a prestigious brand like Goldman to launch an independent firm, which in 2010 was a rare occurrence by today's standards. Yet after 7 years at Goldman, he felt things were changing at the firm, limiting his ability to serve his high net worth clients' needs and continue to grow his business into the future. So Justin launched Atlanta-based RIA Berman Capital Advisors, a firm that grew from managing $1 billion in client assets to $5 billion over the course of 10 years. I encourage you to listen to that episode, because it's a narrative that not only illustrates how making the leap to independence has changed, but how an advisor's desire to do so can be far stronger than the obstacles they might encounter. In September of 2021, it was announced that Justin's firm would merge with Crescit Asset Management. So the big question is, why? Why would a successful independent firm decide to align with a multifamily office like Crescit? Why would Justin be willing to give up control of the business he built? Once again, he looked at the future, the needs of his clients, and his firm's ability to serve those needs and grow the business going forward. And in Crescit, he saw the right partner to fulfill his plans well into the future. In Justin's words, he wanted to be more than a spoke to his clients. He wanted to serve as the entire wheel for them. And he saw that opportunity with Crescit. So far, he's proving to be right. In just 3 years, his revenue increased from $17 million to $27 million annually. Justin's story is an important one because it demonstrates that change is constant, that instead of being feared, it should be embraced as a pathway to growth. It's an evolution designed to continually drive toward not just meeting the needs of one business, but exceeding them. I'm excited to have Justin on our show again and to share his story and talk about his incredible growth. So let's get to it. Justin, I can't thank you enough for joining me again.
Thank you, Mindy, for having me back again, and I look forward to the conversation.
Yes. Okay, well, so a lot to unpack because a lot's changed since we last spoke on this podcast series. So for those that aren't familiar or didn't listen the first time around, just give us a quick thumbnail sketch of your background as it relates to your professional journey in wealth management.
Sure. I started my career at Arthur Andersen doing a bunch of tax returns and then switched to the investment side of things where I worked at my CFO, which became Pastone, another really strong multifamily office. And then I started my career at Goldman Sachs after business school, had many good years at Goldman, started my firm, Berman Capital, in 2010, and we recently recapped our firm with Crescent Capital in 2021.
Yeah. So thank you for sharing that. You and I spent a lot of time talking in the first go round about Berman Capital, why you went independent, how you built the firm. What I really want to focus on in this episode is more about what the business looks like today, what was behind your decision to recapitalize and join forces with Crescent Capital, et cetera. But again, just take 2 minutes, if you would, and remind us how you built Berman Capital Advisors. So you had a good career at Goldman. I remember you telling me that then, and you just said it again now. What made you go independent at that point, and how did you really think about building Berman Capital?
Sure. So, as you said, Goldman was a great firm, tremendous resources. And I do believe that really no one has a silver bullet in our industry or has a monopoly on good ideas. But as an advisor, you have an obligation to tap into the best solutions no matter where those reside. And so I wanted to go independent. And I started with the end in mind, meaning if I could create a family office that was good enough for my family, in this case, my grandfather, then I thought other families would join. And that's exactly what happened. And it's the mantra, if you build it, they will come. And so I was fortunate enough to work for my grandfather and attract clients from Goldman and really built a strong multifamily office.
What was it that was missing in the traditional space that made you want to go independent, that made me say, I'm going to build it with the end in mind? And what was it that you couldn't have gotten, whether it be at Goldman or my CFO or anything else?
I think the utopia of our space is really to be a family's first call, no matter what the issue is, whether it's a tax issue, an estate issue, an investment issue. Our job as an advisor and as a fiduciary is to be that first call. And in certain business models, you're just not able to do that for whatever reason. But the reason why we wanted to build Berman Capital was to use my background as a CPA, but combine that with estate planning and other family office services to really treat each family as its own single family office. And we were not able to do that under certain business models.
Got it. Okay, that makes sense. So tell us a little bit about the business as it looks today. How much in assets was or is the Berman Capital part of Crescent now managing?
So we manage about $6 billion of assets. I think when we merged with Crescent, we were around a little bit south of $5 billion. We have two offices, Atlanta and Austin, and that is basically our business as it stands today. I would say our revenue has grown significantly since joining Crescent, and we've added some more talent on the people side as well.
How much has the revenue grown?
I would say our revenue, when we did our deal, we were around 17 million, and now we're probably 27 million.
Amazing. Okay. I really want to unpack that, but I want to give a little more background just so that people are familiar. So talk to me a little bit about the kind of clients you serve and the things you do for them.
So we continue to focus on the entrepreneurial CEO founder. We have a big focus on first generational wealth at the firm because we feel like we can really effectuate an outcome for a first generational entrepreneur that's coming into money for the first time. So in order to really do that, we obviously want to serve as the quarterback for the family, and we want to partner with them through all their transitions. And I think being able to do that with first generational wealth is very important. We continue today to focus on the consumer product goods space. So in other words, CPG, and we really go deep. And so I think a lot of times in this industry, I see young advisors going very broad. And I think the more successful ones really focus on a particular city or a particular industry where they can go really deep and understand everybody that's in the industry, all the service providers, all the wealth that's in a certain city, who the influential decision makers are, et cetera.
What do you think has contributed most to your client retention rates?
I think it's really just being a substantive advisor. And I think that we have been able to attract tremendous talent. We've been able to offer much more services than we did at Berman Capital. And it's really important. I want to make sure people understand this. When I was at Goldman, we trust and estate planning and wealth management, I would say, are table stakes. Everybody has to have that. However, if you go a step further and you talk about outsourced CFO services, you talk about income tax planning, you talk about family governance, lifestyle services, financial planning, those are really what makes a client and a client's relationship sticky. However, there's a lot of firms out there that will do table stakes, and it's really a loss leader for the firm. At Crescent, and really what attracted me is our family office service division is a profitable business. We are in the business because we want to be in the business, not because we have to be. And if it's a profitable business, we're able to attract tremendous talent, which helps with the retention.
Yeah. All right. So let's unpack a little bit. So in 2021, you decided to merge Berman Capital Advisors with Crescent. First of all, let's start with the beginning of that. Why then? What was behind the decision to give up sole ownership of Berman and merge or sell at all?
It's a great question. I think in 2021, we were at an inflection point in our business where we were attracting many nine-figure families that, quite frankly, in terms of needs, investment management was not in the top 2 or 3 reasons why they chose a firm. We needed tax planning, we needed estate planning, we needed family governance, some of the services I just spoke about. So instead of hiring a bunch of people to do this, we decided to merge with Crescent, who had built out these functions. And the other reason why then was because we were starting to see these super regional RIAs develop. And we felt that if we weren't going to be a part of one of these super regional RIAs, we were going to lose on people, on talent, and then sometimes on opportunities when it comes to investments.
There's so many directions I want to take this. So lots of different potential acquirers, larger RIA firms, private equity firms who you had enough size and scale on your own, even without the exceptional growth you've experienced in the last few years, for them to have invested in you individually, to have been acquired by a bank. There's so many people that are hungry for acquisition these days, and any one of them would have been a good, solid acquirer. Why Crescent? What is Crescent's value proposition, and then why them as opposed to anybody else?
Look, I think if you always start with the end client in mind, it's a pretty simple solution and it's a pretty simple answer. And so, yes, we'll be approached by banks and private equity firms and minority partners, of course. But we asked ourselves as a management team, how is our client experience going to be better if we merge with XYZ firm? So in Crescent, what we liked first and foremost was it was very similar to how I started Berman Capital for my family. Well, Crescent was started by founders that were the first clients. And so it was started by clients for clients. I think the culture of Crescent was key, and the leadership was a big sell for us. The other couple other points is fiduciary. There's a lot of good fiduciaries out there. Crescent was not started by private equity. Today, our firm is owned 65% by our employees and 35% by our clients. So because there's no private equity, there's really no shot clock capital. And I felt that if we were going on that private equity roadmap, we were going to be on a hamster wheel and it was going to be tough to get off. Our job and what I really wanted to do was build a 100-year-old firm. The other thing is the meritocracy of the firm. We're big, but we have a culture of best idea wins. While there's a lot of good firms and a lot of good people out there, Crescent was very much leaning into us to say, how have you built your firm over the last 10 years? And what are the best practices that we want to adopt? And then today that still rings true. And so I really appreciated that. And I really appreciated that at the time, Crescent was probably in inning three of its journey. And I felt like I could effectuate the outcome of the company.
Yeah. So, how about the courting process? Was it that you woke up one day and said, I think we're at an inflection point and I need to begin to contact potential acquirers, or had Crescent contacted you?
Of course, every firm gets calls from people. And so we decided to hire an investment bank. We
Mhm.
hired Raymond James to really run a very tight process where they reached out to call it 10 interested parties that they thought would be interested in our business. But at the end, there were probably five that we were very serious with. As you mentioned, some that look like private equity, some that look like a minority partner, and then what I would call more strategic.
Yeah. And how overwhelming was it to sort through that? Each of those constructs offer differing pros and cons. For example, a minority investment, say like a merchant, might have allowed you, probably would have kept your brand more and done things. You would have been more independent. And it's not that you're not independent with Crescent, but there are certain things that might have been different in other constructs. How did you decide upon Crescent in a crowded marketplace of potential acquirers?
No, I think that's great. And I think that, again, the main reason was really to accelerate our growth by being able to offer services that previously we really weren't able to offer in house. And I think that was the main reason at the end why we chose Crescent was, again, putting the client's hat on. Is this going to enhance our client relationships and make our clients better? And with Crescent, we felt that it would. And to this day, I wouldn't change anything about the transaction.
Yeah. A couple questions about that. So you said what drove your decision was to be able to offer services in-house that you couldn't as either Berman Capital Advisors or presumably at Goldman or elsewhere. Most advisors, top advisors that service ultra high net worth clients like you do, that work at traditional firms, believe that they have access to everything that they need. So, in your case, was it that your clients were saying to you, hey, we're looking for outsourced CFO services or tax planning or lifestyle services or family governance? Or was it you recognizing where the puck was heading and proactively seeking it?
It's a great question. I would say it's probably the latter. Tax planning always comes up in every conversation, and being able to sit down with a client and run through a tax plan at the end of the year, not just to go through, okay, what gains or losses you have, but really put all sources of income through a tax program is helpful. I think another big reason was Crescent has a team of former private equity and real estate professionals that work at the firm. And there's not a week that goes by where we're not being shown a private deal from a client, a real estate deal, or an operating company. And at Berman Capital, we had no clue how to diligence a direct deal versus a fund. A fund, quite frankly, is probably is easier to diligence than a direct deal. And so that was a big reason that Crescent was attractive, because they had this team that even if it was a 3, 5, 10 million equity check, they would take the time to diligence this for our clients and show them, and we would talk to them about the good, the bad, and should you do this? And if so, how much? I think at the banks and other models, it just doesn't happen. They might say they do that, but I'm pretty sure it's very hard to get people's attention unless you're talking about $100 million, $250 million equity raise, for example.
So think back to the time when you were in more of the traditional space. Again, let's use Goldman as an example. Was the notion of investing in private deals, was that on your radar at the time? And is it more that you couldn't do it the way you wanted to, or more that the diligence didn't exist for a client with, say, 25 million or 100 million versus a billion?
Yeah, I think it's more that it did exist, but the question always became, was it the best deal or best fund out there? So the puck was going to more alternative investing, like how the Yale Endowment is invested, and ultra high net worth families want to invest in alternatives and want to talk about the deal, quote unquote. The problem is at the banks where they're managing hundreds and hundreds of billions of dollars, they need funds that can take that capacity and invest it.
Right.
And probably the best investors in the world, first of all, don't need anybody's money, to be honest. But if they do, they might only take one or two new LPs a year. And that's what was so eye-opening, is that there's so much talent out there that was not on the bank's platform. And to be able to access that today, you really need scale and in the independent sense of the word. And that is why we continue to access some really interesting ideas and funds at Crescent.
Yeah. Were you aware of those sort of limitations you're talking about when you worked, but forget before Berman, when you worked, let's say, at Goldman? And my question isn't meant as a pejorative against Goldman. I'm talking about I'm wondering if advisors in the traditional space, if you as an advisor in the traditional space at Goldman in your case, were aware of that limitation around access to private investments. Or, because you said you really were a pioneer in terms of thought. You went independent and formed Berman Capital at a time when it wasn't really in vogue to do so. And driven by the notion of beginning with the end in mind and wanting to do things for clients you couldn't. But I'm wondering if you were aware of that specific limitation in terms of access to and diligence for access to private investments for clients that had less than $1 billion or less than 500 million.
You're not really aware of it while you're in the day-to-day at the bank. And because the Kool-Aid inside these banks is very strong and you're drinking it, and you just think that your way is the best way. And then you have funds that come on the platform that are preeminent blue chip names, Blackstone, Ares, Carlyle, KKR. And you say, wow, we can get access to this. But if you really peel back the onion, truth of the matter is you're not going to get fired for hiring a Blackstone or for allocating to Blackstone or Carlyle, because those are great managers. But at the end of the day, there's just better performers out there that might be a diamond in the rough. And you're trying to find the next Blackstone or the next KKR or a spin out of the team. And so while you're inside a bank, you're drinking the Kool-Aid and you're just allocating to these managers that have great names that you read about every day in the Wall Street Journal. But I think by being independent, it's just the sandboxes are much larger and the world is really available to you as long as things pass muster and pass diligence.
Right. It's interesting. I'm thinking about what you're saying. And the reality is that most advisors will tell you they may be, if they work, let's say, for the Merrills and Morgans and UBSs of the world, Goldmans of the world, they'll say that, yeah, it's a little frustrating. It's a lot bureaucratic. There's a lot of red tape. It's sometimes not all that efficient. They would love to have more freedom and control. But your clients are growing. It's more than good enough. And then a small percentage of folks get to a point like you did when you launched Berman Capital and many of the others that we've been privileged enough to have guests on this podcast, get to a point where they say something happens. That's their aha moment that says, wow, I wonder if there's something better. And so I'm wondering, what was your aha moment? What was it for you that made you say, maybe there is life beyond this, or life I should be exploring beyond this?
The aha moment for me was just the fact that these entrepreneurs that are making money for the first time are now getting flooded for everything, whether it's investment ideas they're being shown or it's creative tax planning. And I just knew that if we were going to be that first call and we were going to have to opine on what they were showing us, the model was not going to work long term. And there are many firms out there that are really good, and they're really good at lending money, or they're really good at cash management. But the model has shifted so much to where you need to be that first call, and that first call might not be an investment question. And I think so many people at the wirehouses are just fixated on investments are the end all be all. And as the world has changed, whether it's changed to index funds or whether it's changed to just making the investment business easier, where it's not rocket science, then how are you going to wake up every day and say, I need to add value to this client, and it's not going to be through my investment expertise? And that was the aha moment.
I get that. We see that, we hear that, and I think that makes enormously good sense because it's not only about being your client's first call, it's being your client's every call.
That's right.
So I'm wondering, before you were able to offer tax planning, outsource CFO services, lifestyle management, family governance, et cetera, where did your clients go for those services?
To be honest, they went direct to the service provider. So yes, did we have a leg up because I did a lot of 1040, so I was pretty well versed in the tax code and the estate law? Sure. But they went directly to the service provider. So we were in a position where we weren't the team, we were just a member of the team. And so we were a spoke in the wheel, but we wanted to be control the entire wheel. And so they would go to their trust and estate advisor, they would go to their accountant, a lot of times that charge by the hour, versus coming to us. We just were not in that position at the time.
Got it. All right. I want to focus on what you said in terms of growth from just south of 5 billion to 6 billion in 3 years, meaning from 2021 when you merged Berman Capital with Crescent Capital. And probably more noteworthy is growth from 17 million at the time to 27 million in 3 years' time. So what do you attribute that extraordinary growth most in such a short period of time?
I think it's just being able to offer these services that are being run internally by some really talented people profitably, meaning these most of the times are not being charged on an AUM basis. These are a flat dollar fee on top of the assets under management fee, the traditional basis point model. So we have two ways to charge families. Assets under management is the typical way, but we also will charge a flat dollar fee based on the menu of services that a family needs. So if they want us to run 2 family meetings a year, there's a charge for that. If they want us to go really in depth on all of their legal documents, there's a charge for that. And so we're not giving away these services for free, i.e. inclusive in the AUM fee. And that's why our revenue has grown. And I think on the periphery, yes, do we focus a lot of our time on new business? I do personally. And there's ways that being with Crescent has allowed even greater accessibility to families that we want to call on through our digital marketing program. But at the end, I think as long as you're doing a great job for clients, being able to add more services that you're charging for and that clients are willing to pay, then that's why the revenue grows.
Mm-hmm. You said, for example, if we have a client that wants us to run 2 family meetings for them a year, I assume that's not something you could have or would have charged for at Berman Capital because you didn't have the expertise, you didn't have the manpower to do it. In other words, what is Crescent doing for you in that regard that you couldn't have done on your own?
That's exactly right. So we have 3 members of a family governance team that will meet with each family member, generation 1, 2, and 3, figure out what values, mission, again, not speaking a word about investments most of the time, and planning out family meetings, planning out family conferences. So that is a charge that we would give to our clients that they would pay. Or can we curate a phenomenal trip to Europe? Yes, we can. And we're going to charge our time for that. And so we did not have the expertise internal to do that. Or you want us to do research on how can we help the homeless population in Austin, Texas through philanthropy? So yes, we could spend our time researching all the great organizations in Austin, Texas that focus on the homeless population, but that wasn't our core values, nor it was our values, of course, but it wasn't our core work product. And so now we have a team that will talk to clients and help them about their philanthropic endeavors.
So of the $10 million in additional revenue annual revenue you've generated in the last 3 years, how much of that comes from being able to charge a flat dollar fee for services you couldn't before? And how much approximately, and how much from just growth in your investment management fees?
I would say today it's probably 50% flat dollar fee, 50%. And I think that what we've done a nice job of is any new relationship that we're bringing on, they have a proposal in front of him or her with a flat dollar fee component and a basis point component. And maybe we don't charge as much on one side, say the AUM, the investment side, but charge more on the family office side. That's, I would say, the breakdown of that. And clients like it because it's transparent. We only get paid by them, the client. And so it's transparent, it's clean. And the clients are going to know every quarter they're going to have to pay this amount of money. And these are going to be the deliverables for that quarter on the family office side.
People want to have agency over the decisions that they make. So they like the fact you're giving them a choice and they get to decide how they want to pay.
It's literally a menu of about 100 services where they check the box. And then we come back to them and say, we will give you a detailed proposal. But it goes back to every day our team has to say, why shouldn't a client just open up a Vanguard account and put 60% of your money in the S&P 500 and 40% of your money in some bond index, shut your eyes for 10 years, and probably you're going to have more money than you will today. That is our competition, truly. And so we have to have these services, want these services, hire the best people to deliver these services to make sure that our firm's going to continue to grow.
And remain relevant.
Exactly.
I want to ask you something you just mentioned. Of the $5 million or so of growth that's come in as a result of being part of Crescit, the additional AUM growth you mentioned, I know that Crescit has a very interesting and very robust and cutting edge digital marketing program. And it sounds like you've really been a beneficiary in terms of their driving referrals of target ultra high net worth clients to you. Talk to us about that for a minute because it's unique and it really speaks to what's possible in the independent space that's not possible elsewhere.
First of all, the digital marketing was started by a partner at Crescit in the Reston office, David Karp. And what they did was they said, okay, people might in this day and age find you online and you have to be able to service those folks. Not in my wildest dreams did I think that 9-figure families would find a family office online and hire that family office within a week. And so, yes, is there money that we have to spend for this? Of course, but the return on investment is so significant. And I just never thought that people would do this. And it steers more towards a younger generation, maybe folks that don't want to come into quote unquote an office are fine with having calls, Zoom. Geographic location is not that relevant, not that important, but they want to make a decision and they want to make it quickly. And so whether it's our thought leadership in terms of articles that we put out or some of our events that we host virtually, somebody grabs it and they're interested in exploring what Crescit means for their family further. And it's wild, but
you are not alone in being skeptical of the notion that a 9-figure family, let alone a 7-figure family, would or could choose an investment advisor or choose an advisor online from digital marketing efforts. So can you give us an example of the why and the how of it?
I think the why is that they have a need and they've gone out and they're searching for a need. And obviously a lot of work today is being done over the internet. So they're searching the internet for that need. And because of our creativity, we're popping up. And then not only are we popping up, but we're following that person through ads, et cetera. this thing is way over my head, but this is what I understand. And then they'll either fill out a form online that they want to talk to a founder, or they want to set up a call. The call is set up, and within a week or two, it's either a client or it's not a client. And so I always say a yes or a no is better than a maybe. They are making a decision quickly. And it happened today. It's happened last week. I was on a call that was generated by our digital marketing efforts. And I would say Jessica Malkin, who is our chief growth officer, does a phenomenal job with this. And it is a big focus of the firm. So I will say the only thing you have to be careful about is the quicker you are to hire somebody digitally, the quicker you are to fire them as well. And so, because there is no relationship being built over a dinner or over a lunch or over an event. And so you better make sure that you are servicing that client. You're probably over servicing that client initially, and to make sure that they're real and they are going to stay a client for many years. That is one thing that needs to be the focus.
A firm of Crescit's size and scale opts to do that. So it brings me to the question that I think a lot of business owners, when a business owner, I'm talking about an advisor that probably, like you, traditionally worked at a traditional wealth management firm, a big firm, went independent, has run an independent business for a period of time, and then, like you, comes to an inflection point. And the number one thing that stops them from opting to sell or merge is they don't want to give up control. The whole reason they went independent is because they want to own 100%, have 100% agency over their professional life, and have a certain amount of skepticism about bringing partners or owners in. And I guess I have a two-part question. The first part of the question is, what would you say to those people about how you reconcile the decision to give up control? And then the second part of the question is, so I'm going to imagine that part of the answer to that has to do with you believe that you would grow more with Crescit than without it, and it was worth whatever price you had to pay in terms of giving up control. So forgive me for being long-winded, but you see where I'm going with that.
Yes. Look, I think control is a confusing word, especially when it comes to deals, for example. One of the main things that attracted me to Crescit is the culture and the fact that I talked about earlier, the best idea wins. So many times people will say the best idea wins, but then what they don't say is, and I always have the best idea. Not here. So operationally, we really didn't give up control because a lot of the ways that we serviced our clients were adopted by Crescit and were adopted by the firm, because if it was working for us and it was a best idea, why not make that available to every client of the firm? And that is where I would say it's a meritocracy. Some of our processes and procedures have come from other firms that we've acquired. And that has been great because it's refreshing. You get so sucked into the day-to-day and you say, wow, we must be doing a great job because we're growing. But then there's another firm or another team that comes along that has a better idea and it frees you up even more. So from that perspective, yes, I think that we did not have to give up control on the operation side. Financially, of course we did. We reached a point where, in order to scale, and as I mentioned, to provide even more services to our clients, a partnership with a firm like Crescit was going to be necessary. And I was ready at the time to link arms with Abby and Eric, our two founders, and the broader team, really to bring our clients and, as equally as important, our team, our people, to the next level. Our team now has a defined career path, which when we were 40-person firm, not so clear as to where the direction of certain team members either wanted to go or was there even a position open for them. So that was really important as well.
Yeah, I think that makes sense. No, you're talking about giving up financial control. And I don't expect you to share numbers or specifics with us, but give us a sense. You say you're a partner with Crescit. Was it a merger? Was it an acquisition? Talk to us a little bit about what that looks like.
Sure. From an operational perspective, it was really a true merger. From a financial perspective, it was an acquisition. And I was fine with that. Again, if we wanted to really grow to the next level, we needed to basically be acquired and have a firm take what we were doing that was working really well, add to it, and create an environment where 1 + 1 hopefully equals 3. So the beauty of it in terms of a transaction is like I mentioned, Crescent was in inning 3 when we did our deal. And a lot of the compensation was in the form of stock, where you're a true partner. So, yes, was it a financial acquisition? Sure, but we still have the stock component. And so we are all rowing the boat in the same direction, whether it's in Atlanta, Georgia, whether it's in San Francisco or Reston or Minneapolis or New York or Menlo Park. We all want to win. And what affects us in Atlanta is going to affect the people on the West Coast. And so it's a true partnership and it's a true one team culture where your experience at Crescent should not be dictated by the office that you work with or the team that you work with. I find it so often that your experience as a client is going to be dictated by the team you work with. That is not the case here. We are one firm and the culture is set up in such a way.
Yeah. So let's talk about the future for you and personally, professionally, and for Crescent. So, how much, or if any, percentage of your decision to sell to Crescent was driven by the desire for succession planning on your part?
Zero. I'm young. I'm 47 years old. I haven't really thought about retiring. To be honest, I don't really have any hobbies other than maybe Notre Dame football or being involved in the community. I'm not a golfer. So I think I do this the rest of my life. And so, yes, it was not for succession planning at all. And I'm having fun, a lot of fun.
And how about what you think, how your role will expand? How do you think things change over time with Crescent? And what do you think will happen to Crescent? In other words, you're saying, and you're right, that a large part of your transaction came in the form of stock. So you're betting on Crescent having some sort of transaction or the ability to monetize that stock at some point. So what do you think all that looks like?
Yeah, so I think in terms of how I spend my time today, I would say gives me a lot of pleasure to say that I spend about 25% mentoring some of our younger advisors across the country. I really enjoy that. I would say I spend 25% of my time on the strategy of the firm as a whole, where there's a group of 6 of us that do that. And then 50% of my time is spent on the 10 families that I work with. So I still work with clients, and obviously I love that. In terms of the future of Crescent, the greatest partnerships in the world, you could argue, were private. Goldman Sachs pre-IPO, Alvarez and Marcel, some of those names that really were designed to be 100-year-old partnerships where every year we would get a nice big dividend check and people knew that it was because of all of the efforts of the team. And I think that's the direction that we are striving to do is how do we build a great 100-year-old partnership. And my colleague Eric Becker is writing a book on the greatest 100-year-old partnerships, the Alex Browns of the world, and those firms. And to be able to give a dividend check to all of our employees, because again, every single employee at our firm owns stock, is powerful. They really understand what that means. If it's just a piece of paper, it's pretty irrelevant. But when they are getting a dividend check based on their ownership, they say, okay, there's value there. And I think that's the direction that we will continue to go in, is just to continue to build the firm, hire the best people, and really service our clients like they deserve, which is really over servicing them.
Yeah. So, what do you think the future of wealth management looks like? And I guess what I'm looking at more specifically is how do you see the role of a financial advisor evolving over the next decade or so? I'm taken with your description that to be just an investment manager made you feel at significant risk for becoming irrelevant. You wanted to be more things to your client. How do you see that evolving further over time?
Look, I think over maybe the past 5 to 7 years ago, the word fiduciary came into the field where everybody wanted or was interested in really truly what does a fiduciary means. Then maybe the last 3 to 4 years ago, people were starting to talk about consolidated reporting, and that's how they differentiated themselves, that they were able to provide that service or this service. The future of our space is how can you as an advisor be the most substantive advisor out there? And to your point, Mindy, it's not talking about, well, what did the market do today? Or how much is NVIDIA of the S&P 500? Is that the reason why the markets are going up or down? It's really encompassing everything that matters to a family truly outside of the investment world. And so I think the most successful advisors and firms are going to be the ones that have the most substantive advisors out there. Now, does AI play a role? Are we seeing that in our space? Yes, absolutely. So there's firms out there, there's technology out there that will, for example, pull K1s from all the custodians, all of the Citgos of the world, the Cartas of the world automatically. Has that been in vogue recently? Yes. And I think AI will continue to help advisors deliver a best in class service. But at the end, it's not going to be what a computer does. It's going to be what you do to separate yourself. And I always tell people that you have to realize that it's not the firm's name that's on the business card that's really going to separate yourself from others, because there is a tremendous number of great advisors and great firms out there. It's really the person whose name is on that business card. And that is really what's going to separate you from everyone else.
Yeah. So I want to close with a question. You said that you spend a good percentage of your time now mentoring younger advisors at the firm, and what a worthy and noble cause that is. So I'm wondering, what do you think is the most impactful advice that you would give? What's the most impactful wisdom that you share with those younger folks?
I would say a couple things. One is not every piece of business is good business. And you'll figure out for yourself what good business and what not good business is. Because the good business are the clients that you work with that appreciate you, that love you, and that are picking up the phone and telling all of their friends about you. So that's one. I think most importantly, though, in our business, you have to be humble and you have to realize that you aren't the only one out there who's good at your job. And the more you can understand that early on in your career and realize that your job is really to sell. And as I tell people, no matter what you want to do in life, whether you want to be a doctor, an accountant, a teacher, you have to sell at some point. So realizing that early on is critical.
Thank you for not only that wisdom, but all of the transparency and generosity. Clearly, you've built something really special, both at Berman Capital Advisors and by making the decision to join the right partner. The numbers you've put up, the growth you've experienced is certainly emblematic of that. And I'm really grateful that you were willing to take the time to share it all with us again.
My pleasure. And for anybody listening, I love your podcast, Mindy. I listen to it every week. And I always tell our advisors, if you're not listening to Mindy Diamond's podcast, then you're missing out.
Oh, thank you. I really appreciate it. So let me ask you a self-serving question. What is it that's someone who's already done a transaction that's clearly grown, you're at the pinnacle of your career, what do you get from it?
There's always better mousetraps, and there's always people that are building businesses different ways, and you get to learn from all of these very successful people. And so when people leave and join other independent firms, there's always good reasons. And when they're at the independent firm and they're servicing their clients, there are always good reasons how they're doing that and the ways they're doing that. And I pick up nuggets all the time.
I love it. To be honest with you, the goal we had in mind when we launched the podcast, we deliberately make sure that we're very thoughtful about the questions we ask to make sure that it's really substantive. It's not just questions for question's sake, but it's asking questions that we know will be most impactful for anyone thinking about building a business with the end in mind, as you clearly have. So I can't thank you enough again. Wishing you continued success, and I hope that the next 3 years are as successful as the last 3 have been.
Thank you very much. I really appreciate it.
As a financial advisor, you hold yourself to the highest standards of integrity, honesty, and credibility. You are successful because you take your professional responsibilities seriously and are dedicated to your clients. But are you living your best business life? Are your goals aligned with your firm's, or could a better option exist? Should I Stay or Should I Go is a book written with you in mind. It's a self-guided journey that walks you through the key steps that we take with our advisor clients. This strategic thought process and roadmap to professional self-discovery is designed to help you ask the right questions and think critically and objectively, whether you're considering change or not. Learn how to get your copy at diamond-consultants.com/thebook.